I'm a lawyer, that's right, but I'm talking about changes and learning. We're talking about the fact that crises trigger adaptation processes. These adaptation processes are learning processes. And we readapt ourselves in respect of attitudes and behavior. Yet, once we have accomplished that, we realize that the outcomes of these learning processes produce new problems, or, to put it positively, challenges, forcing ourselves again to readapt ourselves and questioning ourselves whether it was right what we did in the past. I want to exemplify that with respect to the two financial crises we suffered in Europe, starting in 2007 and ending maybe now or maybe somewhere in the future. Insofar, we have to consider that the world before 2007, well, was not a different world, but it was a world with respect to financial markets that lived on a different paradigm than the one that is dominating today. The paradigm in the years before 2007 was that globalization is accomplished. The main financial centers in the world, and there are three ones, the United States, Europe and Japan, were highly interconnected, and they worked highly efficiently. And this high efficiently can be seen with respect to the techniques of pricing risks. I'm a poor lawyer only, and I'm sure that economists could explain it much better, but what I have learned during the last crises is that it was one of the tasks of the lawyers to develop legal techniques in order to make the mathematical models work. One of these legal techniques was, for example, to develop derivatives. Derivatives permitting the market participants to price risks, or techniques to transfer these risks. One of these techniques is, for example, securitization, one of the techniques that was at origin of the financial crisis in the United States in 2007. Looking at these techniques, we realize that the markets that used these techniques, derivatives markets, securitization markets, were partly much bigger than the markets for the underlying assets. This was the world before 2007, and the idea was these markets are perfect, they're efficient because they're able to identify and to price and to transfer risks. When the crisis popped up in 2007, markets and regulators had to discover that they had not recognized one risk that came now to the forefront. This risk is called systemic risk. There are many ways in order to describe systemic risk. One way to define systemic risk is it's a risk that results in a tremendous economic turndown, damaging not only the financial markets but also the real economy. And what we also have to recognize is that systemic risk can pop up anywhere in the system. Everything can be systemically important. Any Sparkasse or Raiffeisenbank, or at least some of them, can at a certain point in time, under certain circumstances, become systemically important. And accordingly, the definition prepared by the European legislator is that any market participant, any infrastructure may at some point in time become potentially systemically important. This was, as you will probably understand, the beginning of a return, the return of the regulatory state. For me as a lawyer, it was not a return because I believed already at that time that the regulatory state never had disappeared. But at least in the public perception, the regulatory state was back. What does this mean for Europe or the European Union? For the European Union, it meant, in a painful process of learning, the development of the European Banking Union as one of the main elements of reform in order to bring the financial crisis to a halt. Looking at Europe, we must be aware of the fact that Europe suffered or is suffering from two crises, which is a big difference to the United States or to other parts of the world which suffered only from one crisis. In Europe, we experienced the first financial crisis triggered by the United States from 2007 to 2009, and directly onwards, but only in Europe, we suffered from the European debt crisis that had its origin in Greece. Looking at these two crises and its causes, we find something fascinating. We find that small causes may have big effects. Let's look, for example, at the beginning, the official beginning of the financial crisis that started somewhere in 2007. It really popped up and was transferred to Europe in 2008 after one famous or infamous Wall Street investment bank became insolvent, Lehman Brothers. Lehman Brothers was certainly not one of the biggest investment banks in Wall Street, but at that time it was big enough in order to cause tremendous trouble. Looking at the second crisis in Europe, the debt crisis, we must realize that Greece is a small country, and it was even a small country when the debt crisis started in 2010. In 2010, Greece contributed to the European gross domestic product with a share of less than 2.5%. But the fear of a disorderly bankruptcy of a state had the effect of bringing financial markets all over Europe to new turmoil. And these events were the advent of many reforms in the European Union, and I want to concentrate now on one reform, on the reform of financial market supervision in the European Union. The reform process started in 2010, when the European legislator decided to establish the European system of financial supervision. This was quite a simple structure, simple in relation to what we have today. It was based on the existing national supervisory authorities, which got, let's say, a new floor above them, namely for European agencies that had a task to supervise, coordinate, and control the working flows of the national authorities. Very soon it became clear that the system was not bad, but that it was not sufficient in order to bring the financial crisis to a halt. Accordingly, in 2012, the heads of state in Europe decided to establish the single supervisory mechanism, which saw light in 2013. At the core of this new mechanism is the European Central Bank, which is now the supervisory authority for around about 120 systemically important banks all over the euro area. It's a strong system with strong powers of the European Central Bank, and which started working last November 2014. The last step of this reform process was the establishment of the single resolution mechanism, established in 2014 and probably able to work round about 2017. These two mechanisms, the single supervisory mechanism and the single resolution mechanisms, these two elements form the pillars or the cornerstones of the mechanism we call banking union. Looking at what we learned and what we did, we must ask ourselves whether we accomplished the missions that were at the beginning of these crises. One question that bothers me is whether we found mechanisms that are in practice better in order to tackle risks. The pre-crisis world of 2007 was obviously not able to tackle risks efficiently. and I speak of tackling risks in a very untechnical sense, in a very unlegal sense. Tackling means being effectively able to deal with risks. In the pre-crisis world of 2007, we believed that markets are efficient, that markets are able to tackle risks. Now we live in a world where the shift of paradigm is obvious. The idea is that not markets have to overcome risks, but that regulators have to overcome risks. The idea is not that markets should be efficient, but that regulation should be efficient. And therefore, practically all reforms in Europe and in the United States aimed at maximizing regulatory efficiency. So far, so good. But what I personally fear is that we overdid it a bit. We believe that markets are not able to tackle risks adequately. But we run the risk that we produce new risks unknown in the past. Today's world is characterized by very dense, by very detailed regulation that aims at covering risks under identical rules, aims at covering identical risks under identical rules. This means that the legal prescriptions for market activity become more and more dense, become more and more detailed. And the effect could be, I say could be, that in the end market participants act in a parallel fashion, that they react on markets in a parallel fashion because law tells them you should behave in that way, not in the other one. We switch off competition. We switch off competition as a means to recognize and in the end tackle risks. But the risk of the current situation is that all market participants are exposed to risks on the market in the same way, which could mean that regulation that aims at preventing systemic risks produces by its techniques systemic risks. Systemic risk because everybody is exposed to identical economic risks, and risks because market participants react in the same way to these risks. Accordingly, I believe that we should start considering whether competition and regulation are complementary or conflicting systems. So far, we live in a world where competition and regulation are conflicting systems, and where the regulator believes that competition cannot add at all anything positive to the purpose of tackling risks effectively. A second point, and this is now the end of my presentation, will be whether we established a system that is simple and robust enough if in the future, and we're not talking about if, when in the future new crises will appear. And this question refers to the role and mandate of the European Central Bank, the central regulator we have in the euro area. The first problem is that the European Central Bank has a complex burden. It has to deal with monetary issues on the one hand and with the issue of banking supervision on the other hand. Economists can explain you why there are potential conflicts between those two mandates, and I believe that there are actually risks that these mandates can one day in time conflict with each other. Another question will be, in the future, whether the mandate of the ECB is sufficiently robust. And this refers to the scope of powers of the European Central Bank. The European Central Bank is the supervisor for banks, and banks only, and not for other market participants. But what we learned at the beginning of the financial crisis is, and I repeat that, everything in the markets can become, at some point in time, potentially systemically important. Insurance companies, hedge funds, whatever. But the problem is, we do not know we do not know in advance what in the future the systemic risk will be that faces us with the problems we fear. So this is what I wanted to tell you about learning in crisis and about learning to readapt ourselves even if we have just made a tremendous and legally very complicated supervisory reform. Thank you very much for your attention. Thank you very much.